Welcome to Retirement Today. This is your host, Jenna Cairns, owner and president of Beacon Wealth Advisory. And we are here to help you get to and through retirement with financial peace. If you would like to listen to this podcast or watch it again, we are able to view those on YouTube. We now have our own YouTube Retirement Today channel, which you can subscribe to. Or you can go out to our website, beaconwealthadvisory.com, and you can click on the listen to our podcast section or check out some of our past shows by audio on Spotify, Apple Podcasts, and even Amazon Music. So everyone's going to want to stay tuned. Last week, we talked about 401k rollover mistakes, and we had such good feedback on that. We decided we would do another show to share these big mistakes that people make when rolling over their 401k and really how to avoid them. But before we get into that, I want to say hello and welcome my fabulous co-hosts, Tony Shore and Jaclyn Gladhill. Always great to have both of you on the show.
Yeah, great to be here. I'm excited to be here. That's for sure.
Yeah.
I really appreciate it.
Oh, I'm sorry. What's new with you guys?
Well, I've been doing good. I've just been keeping really busy. I mean, the weather is, I've been outside. We've been planting things, getting our lawn, our backyard ready for summer, that type of thing. Jaclyn, what have you been up to?
Yeah, last week, my boyfriend and I celebrated our 4-year anniversary together dating. So that was cute. He sent flowers to the office, so everyone was on over those. But yeah, that was a fun weekend. How about you, Jenna?
That's great. Well, I enjoyed Mother's Day weekend. We actually opened up our pool and our hot tubs. So on Mother's Day, I just relaxed, sat by the pool, worked on my tan, and got pampered. So it was great. But the weather here in Kansas is so beautiful as well. So, and I like your tan. You've been working on your tan too, Jaclyn.
Yes. I mean, I always feel more confident with a tan. Yes. So maybe it's an addiction, but you know.
Whenever you're blonde, I just think it looks good with a tan, right?
Oh, completely. And you get more blonde being tan, you know?
Yes.
So
yes. Exactly.
It goes in, and I am here to make you both look better because I am half English, half Irish. So I have 3 stages. I'm white, burn, and peel are the 3 stages. There is no tan.
How about blister? Is there a blister?
White, burn, and peel. The burn includes blisters sometimes,
okay.
and then we peel, but there is no tan. Yeah. So that's what happens when you're half English, half Irish, right?
I guess.
Or you spend all day in the studio, right? Like I do. So Jenna, how was your Mother's Day? It's good. You had a good one, right? You were relaxed. That's great.
Really, really great. Yes. And my kids, I always love to swim and hang out with the kids by the pool. And I'm looking forward to summer, and it is just gorgeous here. So yes, it was a wonderful weekend.
Excellent. So how are you going to kick us off talking about some of the biggest 401k rollover mistakes? You covered a few, like you said last week. Yeah. We're going to talk about some more today.
Yeah, we sure are. Before we dive into them, I will go through the basics again for those of you that may need a refresher on just what is a 401k rollover. Super simple. It's just taking money out of your current retirement plan at work. So whether it's a 401k, TSP, 403B if you work for a nonprofit company, and you're just transferring it directly from that retirement plan over to another tax advantaged retirement account. Many people like to, for example, do a transfer into a traditional IRA. And do you remember, you all, how we had talked about how important it is to do a direct transfer just from one company to another, so that you avoid all of those issues that can happen with the indirect rollover? Because there are so many different times in life that people potentially need to roll over a 401k, it's just so important to make the right decisions. And if you think about it, most people have most of their money invested in their house, their real estate, and probably their 401k. It's definitely one of the best wealth building tools that people have at their discretion. And so we've got to make the right choices with it. And a lot of people want to know, should I roll it over if I leave the company or get laid off or retire? Or should I leave it at my current employer 401k, right?
Right. Yeah, and that's true. I mean, it's great to know that there are opportunities out there and vehicles out there like you talk about, Jenna, like IRAs where maybe you have more control and you can break away from what your employer has for you, right?
Yes, more freedom, more control, more investment options, maybe more active management, service, all of those kinds of things. So I think now that we've gone through the basics, I'd love to dive into just the first mistake that I want to share with people today. And I think the first mistake is some advisors or clients really are not aware of all the early retirement rules with 401ks. I think most people know if you have a 401k, you probably know that usually you get a 10% IRS tax penalty if you take it out before 59 and a half. Now, one exception to that is if you retire or leave the company once you're 55, you are able to avoid getting that 10% early withdrawal penalty if you are 55 or older. And sometimes they refer to this as the rule of 55. And it's the exception to the early withdrawal rules that really have a levy on that 10% IRS penalty. Now, that does not apply, though, to IRAs. So to qualify for this exception, the person has to have separated service in the year that they turn age 55 and then request a distribution or, obviously it's going to be taxed. But it is very important that that distribution happens at least in the year that they turn 55. Between 55 and 59, you can do this. And Tony, you and I and Jaclyn last week, I think I shared with you just how much I've learned through Ed Slott, the real famous CPA, all of his trainings over the years, right?
Yes, you have.
Yes, I am a fan. Well, Ed Slott at one of the trainings shared a situation that I just thought was very interesting. And he said there was this lady named Mary who left her 401k company, or she left her job and at age 53. And in that 401k, they said that you could take a distribution upon separation of service. So she thought, well, I'm going to retire at 53. And then at 55, I'll go ahead and start living off that 401k because I won't have that 10% IRS tax penalty. And that was what she was under the assumption of. So once she was 55, she started taking money out thinking, oh, I won't get this 10% penalty. Well, needless to say, when she got her tax bill, they said, nope, you're going to have this 10% IRS tax penalty. And she was like, why? And she went to tax court to fight it. She said the language wasn't clear enough in the 401k documents. And the tax court sided with the IRS, saying that really the age of the taxpayer when they are separated from service is what matters, not when they take the distribution. As a result, the 10% penalty was upheld. So you have to make sure if you separate from that 401k company, it is in the year you turn 55 or between 55 and 59. So sometimes if someone retires early, we really have to analyze that because it may not make sense to roll over all of the 401k. They may want to keep some of that 401k if they're retiring early at 55 just to avoid getting the 10% penalty. Because if you roll it over to an IRA during that time, the early withdrawal penalty would come into play. Does that make sense?
Yeah, I appreciate that. That's great information to know. And just to kind of reiterate what you just said was that, retiring early between 55 and 59, that it may actually be smart to just leave some of that funds and that money still in your 401k, correct?
You are correct. Yes. And when you work with a fiduciary, which we are a fiduciary, we really are legally obligated to do what's in the best interest of the client. And sometimes it really doesn't make sense to roll all of it over in a situation like this. So that can be a big mistake that people make if they're not aware of those early retirement rules.
Yeah, no kidding. What is the second mistake that you see people making?
Yeah, well, a lot of people make the mistake of rolling their 401k without first considering the impact of a loan. And I didn't realize this, but Vanguard shared the other day that basically 1 out of 5 401k participants have taken a loan out on their 401k. And I know, sometimes it's for very honorable reasons, down payment on a house, medical bills, that sort of thing. And usually the 401k company will set up like a 5-year payback schedule. But what happens if you get laid off from a company? Okay. If you get laid off from a company and you still have that 401k loan balance outstanding, you only have 60 days to pay that off, or the entire loan is taxable.
Wow.
So that's something to think about when you're taking out loans from a 401k. And if you think about that, can you imagine like, oh, you lost your job, you have no income, and let's say you have $100,000 401k and you took a $30,000 loan. Well, now you have no income coming in and you've got to come up with 30 grand like that. I mean, that could actually really put someone in a financial very bad position, right? So you want to think twice about taking a 401k loan, but I do find that a lot of people have taken 401k loans out, and it's very important that before you roll over the 401k, you ask the question, the advisor needs to ask the question, do they have any unpaid loans? Because if you have an unpaid loan and you just go roll it over, and let's say you owe 30,000 yet, they're going to deduct the 30,000 plus any interest. And then, the remaining balance is what would get rolled over to the traditional IRA, and you'd have a completely taxable event on that loan balance. So I try to encourage people that before you roll over the 401k, try to pay off that loan if you can. Otherwise, it is going to be deducted along with some penalties before the rollover happens. So loans can be tricky, and they can cause taxable events in those situations we just talked about.
Wow. No kidding. I mean, 100% taxable event. You want to avoid those. And it just seems like it's so important then for people to work with somebody who has a lot of experience helping people roll over 401ks and navigate these waters that can sometimes be murky. So how long have you been doing this, Jenna?
Well, gosh, you're going to date me here.
First of all, you started when you were 10. So
yeah, basically. No, I really did start in the financial services industry during college, but when I actually started helping people with rollovers would be around 15 years ago.
Sure.
And then throughout the years, I've attended a lot of different Slott elite IRA training where there's a lot of training on these tax laws.
Sure.
But I would like to think we have, a decent amount of experience. But it really is very important that you work with someone that knows about these little tax intricacies before you roll it over.
Yeah. And Jenna, how do people get a hold of you again to get that second opinion?
Yeah, well, they can do it a few ways. Thank you, Jaclyn. They can certainly go out to our website, beaconwealthadvisory.com, and click on that they'd like to get a consultation, and we can call them back. Or they can just call our office at 1-800-994-8993, and we'd be happy to schedule a no cost, no obligation consultation. And then we can really go more in depth on looking at their 401k, going through all the options, and helping people really avoid these big mistakes that are out there.
Yeah, what great information. Thank you. And to continue on, what's the third mistake that you want to share?
Well, it is really important. A lot of people, if they work with people that are 73 or older, they don't realize the impact of the required minimum distribution if they roll over that 401k before taking the required minimum distribution. And for people that are like, oh gosh, what is the RMD or required minimum distribution? Here's that financial jargon, right? That's out there. What that is basically, if you think about it, if you have a 401k, and let's say it's a pre-tax, not a Roth 401k, if it's a pre-tax 401k, which is really the most common ones out there, if you haven't paid tax on that yet, Uncle Sam at 73 comes knocking and he says, well, you haven't paid taxes on any of this yet. We need to take a little percentage out. And how they figure out that required minimum distribution is they look at December 31st, what was the balance, the 401k balance on that date. And then there's a factor, a percentage that based on your age, they make you take out and pay taxes on. Well, it is very important. Some advisors don't realize that if someone's over 73 and they don't take the RMD out first, they potentially, when they roll it over, the client will get a 6% penalty unless the RMD is removed by October 15th, the year following the year of the last contribution. Usually they end up finding this out once they get their tax notice. But again, it's really important that if you're working with someone over 73, that you take that required minimum distribution out first before you roll it over, so the client doesn't get that 6% penalty.
Yeah, and I don't see how the average person could ever figure this out on their own or know these complexities. And I think it's great, Jenna. I assume this is part of what you learned because you participate in Ed Slott's elite IRS or IRA training.
IRS.
Yeah, well, it is. Yeah. You're learning the IRS codes and how to deal with them at the IRA, learning about IRAs, and you're doing that training. That's really important, isn't it?
Well, thank you. Yeah, I really enjoy it. I don't know how he does it, but he's the famous CPA that's been on PBS, and he does trainings really throughout all of our industry. But he tells such great stories, and I've learned so much from him throughout the years, and it's really helped a lot of my clients take advantage of some of the tax planning opportunities or save them from paying so much in taxes. So thank you. I feel very grateful to have had the opportunity to go to those trainings. And now he does a lot online too. So then that's easier to see as well.
And it's important because this is something that's continually changing, right? I mean, the IRS tax codes, there's always new things being added, things being taken away, changes in laws, the Secure Act, 1.0, 2.0, they change a lot of these laws, especially surrounding RMDs. So I think it's great, Jenna, that you have ongoing education and stay up to date on all of these things.
Thank you. It's really fun, and it does help people. So thank you for saying that. So
well, and so what's the next mistake? I know we want to get to a couple more here.
Yeah, well, this is a mistake of basically not keeping track of old 401ks. I call it the no 401k left behind concept. And you'd be shocked by how many people have lost track of old retirement accounts. And I'm going to actually confess that I even made this mistake. Can you believe that? I'm in the financial services industry, and I made that mistake as well. But I am human, right? We're all human. So I used to work at this real big financial services company in my 20s. Loved it, was really socking money away in the 401k. And then I ended up leaving that company and starting my own business, moved to Kansas, actually from Minnesota, believe it or not, to Kansas. And I did not update my 401k administrator on our new address. And so I wasn't getting statements. I was so busy with life, with moving, starting a business. I just kind of forgot about it, to be honest with you. So I'm not the only one. Eventually I figured out that I had, needed to get things updated, but I'm human. I actually made that mistake as well. Last year, Americans lost track of, are you guys sitting down for this? More than $7.7 billion worth of retirement savings by accidentally and unknowingly abandoning their 401ks. And that actually came from a USA Today report citing national unclaimed property. For this reason, because I've made the mistake myself, I'm a big fan of really consolidating those retirement accounts. It just makes life a lot simpler because you don't have so many statements to keep track of. But, you would think that most people, when they leave a company or, they're just kind of, hey, we're going to park this 401k here. You would think most people, if they're in their 20s or 30s, let's say, that they would leave it in the market, right?
Right.
Would you think that?
Yeah.
Most people actually leave it in what's called the stable value portfolio, even if they're like in their 20s or 30s, because their thought process is, Well, I know it's only going to grow by 2 to 3%, but I don't really have to watch it that much or worry about the market going down. And so while I'm figuring out all this stuff in my life, I'm just going to leave it at that stable value. Well, it's really important to invest in a 401k, but it's equally as important to keep track of how it's invested. For example, if you were in your 20s and you invested $10,000 in your 401k and all it was doing was earning 2% in the stable value portfolio, you would have about 25,000 at 65. Whereas if you had it allocated in some kind of like target retirement fund, a balance of equity and bonds, things like that, that $10,000, if it was potentially growing at closer to like 8% per year, now you would have 360,000. That's different. I know the rate of return you make matters, especially over time, right? So, that's like a $337,000 difference, huge. And so this is really, you think it's safer to throw the 401k in the stable value fund or even like roll it to a CD IRA, but that could be very risky down the road if it's not growing as much and keeping up with inflation. And this is a saying that I've come up with that I really like. Sometimes what is safe today is risky tomorrow. Did you guys catch that? That was good.
Can you just say that one more time?
Sometimes what is safe today is risky tomorrow. And you could actually flip that and say, sometimes what's risky today could be safe tomorrow. Deep Thoughts by Jenna.
Okay. Wow.
Deep thoughts.
Yeah, no kidding.
All right. Take that. Where's the drum roll, right?
Yeah.
So really, it's so important that you don't just kind of forget about these 401ks when life gets busy or you change jobs. Really make sure you know where they're at and know how they're invested, because they can be just such powerful wealth building tools, right?
Yeah. Yeah. And it definitely makes life simpler and, more consolidated by making sure that those 401ks are all together.
Yeah.
And so I think also like beneficiaries would appreciate this so they don't have to call so many companies when handling the estate.
Yes. I'm amazed at how many people don't even know like where their parents' accounts are, or, how many, just like I said, abandoned 401ks are out there.
Yes.
That brings me to my next and last mistake that I want to share is often when people are rolling over the 401k to the IRA and they're setting up new IRA accounts, they'll fill out the paperwork, and sometimes they'll more than likely put a primary beneficiary on there, but a lot of people will just kind of put off doing a contingent beneficiary because it can be overwhelming to determine who to leave the money to. But without having beneficiaries listed on the traditional IRA, even if it's like contingent, where the owner and the primary pass and then it goes to the contingent, if you don't have beneficiaries listed, it can just cause a major probate issue. And you guys probably know why people don't like probate, but it can cost the beneficiaries thousands of dollars to get it out of court, right? Your business is all out in the newspapers and everything, and people just really want to avoid probate. It's just such a pain for your family to have to go through that. So it's really important to update those beneficiaries. And a lot of people will say, well, Jenna, I want to make my trust the beneficiary. Have you guys heard that before?
Yeah.
Right. And that's fine. Like a lot of people will, make their spouse, if they're married, the primary beneficiary, and then they'll put the trust as the contingent beneficiary. But when we look at that from a tax standpoint, okay, if you put a revocable trust as the contingent beneficiary, it is so important. And I will just say that again. It's so important that you work with your estate planning attorney to view that trust and make sure it has what's called the see-through language. And what that means is that if this IRA that nobody's paid taxes on, right, goes into a trust when somebody passes away, if it gets taxed at the trust tax rate, that can be 30+%. Okay. Now, not every beneficiary is at a 30+% tax bracket, right?
Right.
Okay. However, if the trust has the see-through language in it, then the beneficiaries potentially could be taxed at their own individual tax rate. So, maybe somebody's only at a 15 or 20% tax bracket or 24% or whatever. They're not going to want to get this money and have to pay 30+% taxes just because it went through the trust. So really make sure if you have a trust listed that your attorney has written this trust to make sure they have the see-through language in it, so that, again, every beneficiary is just taxed at their own individual tax rate.
I'm going to double check that. I'm glad you brought that up.
Hey, you learned something new today.
Yeah.
I always learn something new from you.
Oh, wonderful. Wonderful. You're going to want to be an advisor by the time I'm done with you, Jaclyn.
Oh, we'll see. We'll see.
Okay, good.
Well, obviously, it's really important for people to update their beneficiary designations. If you have life changes, marriages, weddings, births, deaths, all of those things, divorce, it leads to change those beneficiary designations. And like you said, Jenna, it's something that a lot of people put off. So that's really important, isn't it?
It really is. Yeah.
Jenna, any final last words you want to leave everyone with?
Yeah. We talked a lot about the big mistakes that people make when they're rolling over their 401k. And so you really do need an experienced advisor when rolling over 401k, somebody that has really done that a lot and kept up with all the tax laws. And so our heart is really to help people avoid these mistakes. And so we would be happy to meet with you for a personal consultation to take a look at your 401k or any other investments you have, and just really make sure that they're meeting your needs and that you know all your options. And so it never hurts to get a second opinion. If nothing else, you'll have more financial peace of mind. But again, 401ks are such a powerful wealth building tool, and people have so much of their wealth sometimes in 401ks. You really do need to make the right decisions with those 401ks. So if you would like to schedule the consultation, you can reach us at 1-800-994-8993, or go out to our website, which is beaconwealthadvisory.com. And you can click on scheduling a consultation and we will get back to you. But thank you so much. I enjoyed the show today, and we look forward to hearing from all of you.
All right. Well, thank you so much, Jenna, and thanks, Jaclyn. Great show today. Listeners, thanks for tuning in, and viewers out there. That does it for today's episode of Retirement Today with our host, Jenna Cairns.